Well, economic growth slowed to 1.2% in the third quarter of 2012 on a seasonally adjusted and annualised basis. This is compared with a revised 3.4% rise in the second quarter. Meanwhile, the SARB September leading business cycle indicator ticked up by 0.1% from August. For more on these numbers, we're joined in London by Shilan Shah, Africa economist at Capital Economics. Shilan, thanks very much for your time. Well, a disappointing number, and does it mean that we're in for tougher times to come?
Yes, I think so. I guess the key point from this release is the huge contraction in mining output, which in itself was perhaps unsurprising given the strikes that have affected the sector since August. But looking ahead, things aren't very promising for Q4 and into 2013 either. If we look beyond mining numbers, for instance, we'll see that there was actually a fairly broad-based slowdown. So production and output dropped in other areas of the economy, such as agriculture, finance, and retail, which suggests that domestic demand may be cooling as well. And this presents a real problem for policymakers.
Shilan, when you look at the numbers, obviously we know about the strikes, we know about the unrest, so no one was expecting a good number, and hopefully if this unrest sort of settles down a little bit, things will return to some level of normality. My real question is, you in London now, you know how overseas people think and what they feel. Does this damage, or has it damaged the long-term investment outlook for South Africa? We are highly dependent, as you know, for foreign inflows into the country. And does this create a new paradigm, or is this just one of those things that happen in emerging markets?
Well, I think it's important to make a distinction here between, as you're saying, emerging market growth and advanced economy growth. So while the numbers are certainly weak, they may affect investor perceptions. South Africa's avoided contraction this quarter. So I think we have to use kind of two separate tools of analysis before we look at these numbers. In terms of South Africa's position as an emerging market, I think it probably has taken a hit. And as you quite rightly point out, it's very reliant on inflows into its equities and bonds to actually fund investment, and this is born out of a low savings rate. Should these be withdrawn due to kind of negative or declining investor sentiment, then it could create a real problem for domestic demand.
Shilan, given how the U.S. economy last year was really bad and seems to have improved this year, the British economy looks like it's getting better with today's numbers, and South Africa, looking like it didn't have a great quarter, but manufacturing and exports now, given the state of the rand and the improvement in its export markets, wouldn't that help to buoy South Africa's economy in the next quarter and in the next year?
Yes, I think it will. Firstly, I guess, again, it's important to highlight that South Africa isn't as trade dependent as a number of other major emerging economies. So exports generally make up around 25% of GDP, whereas countries in Eastern Europe, or emerging Europe, for instance, this number is a lot higher. Nevertheless, as you quite rightly point out, the improvement that we've seen out of US data will help. The real problem is the slowdown in the core Eurozone, which looks as if it's heading towards a kind of deepening recession. Now, the Eurozone accounts for 50% of South Africa's manufacturing exports, so this suggests that the manufacturing sector is in for some more tough times ahead.